Welcome to chapter 3 of the Ross text. This is really the finance part of our text. So far, we've been working on the accounting text. We've learned how to develop the financial statements for the company. We have seen the income statement. We've also seen the balance sheet and the statement of cash flow. In this chapter, we are working with financial statements. Basically, we are going to compute ratio analysis, and I'm going to walk you through really quick on some of the basic concepts in this chapter. This is a sample balance sheet. As we had discussed before. A balance sheet is made up of the assets and the liabilities and common stock equity. So on the one hand, we have the asset side of the balance sheet, and we also have the liabilities and common stock equity side of the balance sheet. So on the asset side, we have cash, accounts receivable, inventory, other current assets, total current assets, net fixed assets. If we add the current asset and fixed asset, we end up with the total assets. On the liability side of the balance sheet, we have accounts payable, notes payable, other current liabilities, total current liabilities, long-term debt, common stock, and we have total liabilities and equity. This is a very basic sample income statement. Usually the income statement will begin with the sales revenue, and then we are going to subtract the cost of goods sold. We also subtract expenses, we subtract depreciation, and we end up with earnings before interest and taxes. Then we are going to subtract our interest expense, and that is going to give us taxable income. It is from this amount that we are going to compute taxes. Then with less taxes, we end up with net income. On some balance sheet, we'll be given earnings per share, and we'll also be provided with dividend per share. This is a sample statement of cash flow. As we had discussed before, the statement of cash flow actually captures three major activity. We have cash flow that is coming out from operating activity. We also have cash flow from investment activity, and lastly, cash flow from financing activity. In analyzing the financial statement, there is what we call the common size statement. We have the common size balance sheet and the common size income statement. With the common size balance sheet, it computes all accounts as a percent of the total assets. So we take all accounts on the balance sheet and we divide it by the total assets. And for the income statement, we take all items on the income statement as a percentage of sales. So this helps us to be able to do comparison of the different financial statements. We can compare different types of companies, large and small, once we have standardized those financial statements. In the heart of this chapter is really on ratio analysis. Ratio analysis is very important because it helps us to be able to compare the company. We can make comparison through time. We call that time series analysis, and we can make comparison with other companies in the same industry. We call that cross-sectional analysis. So we are going to look at different types of ratios in this chapter. Those ratios can help in decision making internally within the company, and it can also help with decision making externally. Somebody that is external trying to come into the company either for employment purposes or for investment reasons will analyze the financial statement, will look at the different ratios to be well informed in making decisions. We are going to look at a couple of ratios. We can classify them under broad headings. We have what we call the liquidity ratios or short-term solvency. We also have what we call the financial leverage ratios or long-term solvency. Some texts will call it debt ratios. We also have, as a broad category, asset management ratios or turnover ratios. Some texts will call these ratios activity ratios. And then we have profitability ratios. And lastly, we have what we call market value ratios. So we are going to look at series of ratios. The way we compute these ratios is to have first an understanding of what they imply, and then we need to look at the formula. We go to the financial statements that we just looked at and be able to pick out the figures, the numbers of the financial statement and do computation. So the first group of ratios that we want to look at is what we call the liquidity ratio. The liquidity ratio. Broadly speaking, these ratios will help us to be able to tell if the company has enough current assets to be able to pay off their current liabilities. It tells us the company's ability to meet up with their short-term obligations. So the first liquidity ratio is what we call the current assets, the current ratio. The formula for the current ratio is current assets divided by current liabilities. So as we already know, current assets and current liabilities are on the balance sheet. So we'll go to the balance sheet, we'll look for the current asset and the current liability. And we are working on the most recent year to be able to compute this ratio. So if we go back to the balance sheet, we are looking for the current assets. So we can see we are working with the year 2015. So this is the current asset, 2256, and then we need total current liabilities. This is the total current liabilities, 1995. So that will help us to be able to compute our current ratio. So in that case, current ratio is going to be the 2256 divided by 1995, and that is 1.13 times. So that is the value for the current ratio. So as I've said before, all this liquidity ratio suggests to us the company's ability to meet up with their short-term obligation. So the higher the ratio, the better. The higher ratio suggests that the company has enough current assets to pay off their current liabilities. It suggests to us that the company is able to meet up with their short-term obligation. The second ratio that we want to look at is the quick ratio. The quick ratio. The quick ratio is a modified version of the current ratio. It is actually current assets minus inventory divided by current liabilities. So with the quick ratio is a more refined ratio of the current ratio. We are measuring the company's ability to pay their short-term obligations. inventory is one of the assets that is extremely difficult to convert into cash. So to get a much stronger ratio, the quick ratio, it will be the same like the current ratio, but it's slightly modified. So we'll take current assets minus inventory divided by current liabilities. So we come to the two financial statements that we are looking at in computing these ratios. So we will go again to the balance sheet. So this is the balance sheet, and on the balance sheet we are going to look at the current assets. This is the current asset, which is 2256, and then we are going to subtract inventory, so minus inventory 301, and then we are going to divide that by total liability. Total liability is 1995, and when we do that we are going to have 0.98 times. So that will be the value for the quick ratio. We can also compute the cash ratio, which is cash divided by current liabilities. We've used current liabilities before. We go to the balance sheet and we look up cash, the very first item on the asset side. So cash is 696. So we'll take 696 divided by the current liability, and that will give us 0.35 times. That is cash ratio. We can also compute net working capital to total asset. Net working capital is current assets minus current liabilities. So on the balance sheet, if we look at current asset, it is 2256, and the current liability is 1995. So current assets minus current liabilities, that give us net working capital, and then we divide it by total asset. We look at the balance sheet. Total asset for the most recent year 2015 is 5394, so that gives us 0.05. We can also compute what we call the interval measure. So the formula in calculating the interval measure is current assets divided by average daily operating costs. Average daily operating costs. So we've already used current assets before, which is 2256. Now we want to see how we can derive average daily operating costs. Average daily operating costs, that is going to come out from our income statement. So what we need is cost of goods sold plus expenses. Cost of goods sold plus expenses. So we come to our income statement. We see cost of goods sold, which is 2006 plus expenses, which is 1740. That is going to give us our operating costs. We need average daily operating costs. So daily we are going to divide by 365. So when we compute all of this, we have an interval measure of 219.8 days. So the first set of ratios that we have looked at, those are liquidity ratios. Now we want to move to long-term solvency ratios. Long-term solvency ratio. Or in other words, we want to look at debt ratios. So the first solvency ratio we want to look at is what we call the total debt ratio. The total debt ratio. And the formula is total assets minus total equity divided by total asset. So we can obtain all of this from the balance sheet. If we go to the balance sheet, we look for total assets. We have 5,394, and then total equity we have 2,556 divided by total asset, which is 5,394, and that leaves us with 52.61%. So that is total debt ratio. So these ratios generally measure how indebted the company is. So the higher the solvency ratio, it suggests to us that the company is more into debt. It's more into debt. Okay, the second solvency ratio we want to look at is debt to equity ratio. Debt to equity. So it is simply total debt divided by total equity. Total debt divided by total equity. And if we go to the balance sheet, on the balance sheet we can see total debt. So we go to the balance sheet. What we find at the end of the balance sheet on the liability side, we have total liability and equity. So if we subtract common stock, then what we have remaining is going to be our total debt. We need total debt. So we are going to take 5,394 minus 2,556. So that will give us our total debt divided by our total equity. So again, on the balance sheet, our total equity, this is it, common stock, is total equity, which is 2556. So our debt to equity ratio is 1.11 times. Our equity multiplier is total asset divided by total equity, or we can simply take 1 plus debt to equity. So we had computed debt to equity before, which is 1.11. So 1 plus debt to equity, 1 plus 1.11 is going to give us 2.11. And the other ratio we want to look at, another solvency ratio, is long-term debt ratio. The long-term debt ratio, the formula is long-term debt divided by long-term debt plus total equity. Long-term debt plus total equity. So now we are going to go to our balance sheet again. We need long-term debt. So long-term debt on our balance sheet, as we can see, is 843. And then divided by 843 again, which is long-term debt plus equity. And the equity, this is it, common stock, which is 2556. So when we compute all of this, we end up with 24.80%. 24.80%. Okay, the last two ratios are what we call the coverage ratio. So all of those are usually considered a solvency ratio or debt ratio. So the first part is really solvency, which captures how indebted the company is. And then the second part is the coverage ratio, which tells us the company's ability to pay their obligation as those obligation comes due. The first coverage ratio is what we call the times interest earned. So this tells us the company's ability to pay their interest. So the formula is simply earnings before interest and taxes divided by interest. Earnings before interest and taxes divided by interest. So we'll simply go to the income statement to be able to compute that. On the income statement, we'll be able to see earnings before interest and taxes, which is 1138, and we are going to divide it by interest. So if we look directly below, interest expense is 7. Interest expense is 7. So when we take that and divide by 7, we end up with 116.57 times. 57 times. Again, the higher the coverage ratios, the better, because it suggests to us that the company is able to pay their interest when it comes due. The company has enough earnings that they can pay off their interest. So that is times interest earned. Another coverage ratio is cash coverage. With cash coverage, we simply take earnings before interest and taxes, we add depreciation, and we divide it by interest. So as you can see, this is a slight modification of the time interest earned. So earnings before interest and tax plus depreciation. What we introduce now is depreciation. So we come back to our income statement, and we find that depreciation is 116 depreciation. So when we compute all of that, we have a cash coverage of 179.14 times. Again, the higher the coverage ratios, the better. It suggests to us that the company is able to pay their interest obligation as it comes due. All right, the next set of ratios we want to learn how to compute is what we call the inventory ratios. So the first one is inventory turnover. The formula is simply cost of goods sold divided by inventory. So inventory turnover, how inventory is going out fast from the company. So the higher this ratio, the better. A high inventory turnover suggests to us that inventory is going out faster, it's being converted into sales, which is a good thing, because if inventory stays in the company, there will be spoilage, there will be theft, and many things will go wrong. So when a high inventory turnover will suggest to us that inventory is quickly converted into cash. So to compute this for the year 2015, it will be cost of goods sold. We come to our income statement. We can clearly see the cost of goods sold on our income statement, which is 2006, and then we need to divide that by inventory. And inventory we can find on our balance sheet on the asset side. Balance sheet asset side inventory is 301. So when we do that, we end up with 6.66 times. 6.66 times. And then the next inventory ratio that we want to learn how to compute is the day sales in inventory. The day sales in inventory, which is just simply 365 divided by inventory turnover. So this tells us the number of days it takes us to get our inventory out. So why we want a high inventory turnover for a company, it will be good for that company to have a low day sales in inventory. Which suggests to us that the number of days that we have inventory sitting on the shelf is extremely small. So that will be a good thing. So once we have computed inventory turnover, all we do is to take 365 days divided by inventory turnover, which we did above, 6.66. We end up with about 55 days. So 55 days is the days sales in inventory, is the number of days that inventory is with the company before it is gone as sales. All right, we want to also look at receivable ratios. And the first one we want to look at is what we call receivable turnover. So these ratios will help us. It tells us how efficient the company is in collecting on the accounts receivable. So we know that when a company sell on account, when they sell and receive a promise to pay, it is an asset. And that asset is recognized as accounts receivable. So what is the length of time it takes for the company to convert their accounts receivable to sales? So we'll simply take sales divided by accounts receivable. So for sales, we'll go to the income statement. On the income statement is the very first item that is called revenue. This is sales revenue. So it is 5,000 divided by accounts receivable. Accounts receivable is an asset. So we go to the balance sheet, and on the asset side, we can see accounts receivable, which is 956. So when we take that and we do our computation, we end up with a receivable turnover of 5.23 times. Then another receivable ratio we want to look at is what we call the days sales in inventory. Sorry, the days sales in receivable. The days sales in receivable. So we'll simply just take a number of days in a year, which is 365, divided by receivable turnover. We already computed receivable turnover above, and we had 5.23. So when we take 365 divided by 5.23, we end up with 70 days. All right. Another group of ratios we want to learn how to compute. They are the ratios we call asset turnover. So as the name implies, this ratios will tell us the company's ability to use their assets and generate sales. How effective is the company in using their assets to generate sales? So the first asset turnover ratio is total asset turnover, which is simply sales divided by total asset. So again, we go to the income statement and we can derive our sales, which is 5,000 sales revenue, the very first item on the income statement. And then we go to the balance sheet to look for our total income, which is 5,394. So our total asset turnover is 0.93. We can also compute net working capital turnover, which is simply sales divided by net working capital. We have seen how to compute net working capital before. We said it was current assets minus current liabilities, and sales is coming from the income statement. So when we take sales divided by net working capital, we end up with 19.16 times. Another ratio we want to look at is what we call the fixed asset turnover ratio. And the formula for fixed asset turnover ratio is simply sales divided by the net fixed asset. So we go to the income statement and we are able to see the sales value, which is 5,000 divided by net fixed assets. So we come to the balance sheet. When we come to the balance sheet, we are able to see the net fixed asset. So on the balance sheet, somewhere at the bottom here, we have the net fixed asset, which is 3,138. So when we do that computation, we end up with a fixed asset turnover of 1.59 times. Now we go to profitability measures. With profitability measures, they tell us how profitable the company is. So these are profitability measures. So we want these values to be high for any company we are considering. So the higher the profitability measures, it suggests to us that the company is profitable. So the first ratio is profit margin. Profit margin is simply net income divided by sales. So we can get these two figures from our income statement. So our income statement, we have a net income. So you come close to the very bottom of our income statement, you can see our net income. So we have a net income of 689, and we divide that by total assets. So total assets, we get that from the balance sheet. So on the balance sheet, we can find at the bottom of the asset side 5394. So accordingly, return on assets is 12.77%. Another profitability measure is return on equity, which is net assets divided by total equity. Again, if we look at the income statement, on the income statement, we can get our net income. At the bottom of it, the net income is 689. That is the net income divided by the total equity. So the total equity we can obtain from the balance sheet. And the total equity is common stock. Pay this example, which is 2556. So we end up with a return on equity of 26.96%. All right. The last set of ratios we want to learn how to compute, they are what we call the market value measures. So we have the price, the PE, the price earning ratio, the market to book ratio, and others. So what we need in computing some of these ratios, we need the market price per share. So as you know, the market price is not recorded in the books of account. So online, we'll be able to look up for the company's market price. So let's assume that the balance sheet we are considering, the market price is $87.65 per share. We also need shares outstanding. So let's assume that shares outstanding is 190.9 million shares. So the first market value measure that we want to compute is the price earning ratio, the PE ratio, which is simply price per share divided by earnings per share. So market price is what we just read off online, divided by the earnings per share. We come to our income statement. On the income statement, we are able to see earnings per share. So on the income statement, one bed last line earnings per share, and the value is 3.61. So that will give us our PE ratio, our price per share divided by earnings per share. Another ratio is what we call the market to book ratio. The market to book ratio is simply the market value per share divided by book value per share. So the market value per share is given, which is 87.65. And the next thing we need is the book value per share. The book value per share is going to be 2556 divided by 190.9. So in effect, the book value per share is common stock. Which we can obtain from the balance sheet. Common stock divided by number of shares outstanding. We are told that number of shares outstanding is 190.9. So now we need common stock, because we need to get the book value per share. So common stock, which is on the balance sheet. Common stock on the liability side. Common stock is somewhere down here, which is 2556. So again, the Book value is going to be common stock divided by number of shares outstanding, and the market value per share is given. So when we compute all of this, we end up with 6.55 times. 6.55 times. So those are market value. We also have what we call the enterprise value. The enterprise value is simply the market value of stock plus the book value of liabilities minus cash. So the market value of stock, is simply the number of shares times the market price. Number of shares is given, which is 190.9 times market price, which is given as 87.64. And when we do that, we end up with 16,732 plus book value of liability minus cash. So we end up with an enterprise value of 18,874. Lastly, we compute the earnings before interest and tax, depreciation and amortization ratio, which is simply the enterprise value divided by the earnings before interest, tax, depreciation and amortization. So above, we've computed our enterprise value. So simply take in that enterprise value and we divide by EBITDA, which is earning before interest, taxes, depreciation, and amortization. So if we go to the income statement is what we need. We go to the income statement. We are going to find that for us to get earnings before interest, taxes, depreciation and amortization. So we are going to take revenue minus cost of goods sold minus expenses, and that is where we aim. We need depreciation in that formula. So when we take 5,000 minus 2006 minus 1740, once we do that, we are going to end up with our EBITDA, which is earnings before interest, taxes, depreciation and amortization. So it is our earnings, one of the very first earnings that we make, because we are taking revenue minus cost of goods sold minus expense. So that will be our EBITDA. So that is earnings before depreciation and before taxes. So when we compute that, we have an EBITDA ratio of 15.05. It's important for us to know that this ratio analysis can be used internally. Internally, they are used to evaluate performance. It can result in compensation for management that has done a very good job. It can result in comparison between division to know which division, which part of the company is doing extremely well. Internally, ratio analysis could be used in planning the future. It could be a guide in estimating future cash flow. Also, ratio analysis could be used externally. It could be used by creditors. It could be used by suppliers, customers, stakeholders. All of this could be for them to be able to decide whether they want to do business with the company or not, whether they want to lend money to the company or not, whether they want to invest in the company or not. So ratios are used internally and they are also used externally. Those ratios on their own several times might not make a lot of sense. So ratio analysis is always helpful when they are compared to something. Time trend analysis is when we compare the ratios over time. For example, we look at those liquidity ratio. We want to understand what is happening to the company's ability to pay over time. So that is a time trend analysis or a time series analysis. With the peer group, we are comparing the company with a particular peer. Or we could be comparing the company with industrial average to tell whether the company is below average or above average. So that is a brief summary of the ratios that we encounter in chapter 3. Thank you for watching.